Depending where you're joining us, good morning or afternoon or even evening, and welcome to the Q4 Power Play, winning credit card strategies for Black Friday, Cyber Monday, and beyond. I am Matt Tepper, your host for today's discussion and the Vice President of Global Marketing at GDS Link. As we head into the busiest shopping season of the year, we're excited to bring together two industry experts to help unpack strategies that will not only help you navigate, but also maximize the credit card usage landscape during this critical time. Today, we'll be diving into several key areas. First, we'll explore market trends and insights, taking a close look at the evolving and volatile dynamics of consumer spending and borrowing. With the economic terrain being as diverse as it has been the last 12 months, we aim to unpack what these shifting dynamics could signify for the impending holiday shopping surge. Next, we'll discuss crafting Q4 strategies to enhance your credit card portfolio, ensuring that you're equipped with the knowledge to leverage the coming surges in credit card usage that Q4 traditionally brings. From there, we'll delve into the nuances of credit card usage by generational variants, understanding how to personalize offers to resonate with diverse customer segments. And lastly, we'll uncover the value of trended data within decisioning, a critical component for any informed in making and strategic planning within any financial services organization. To offer their insights on these topics, I'm joined by two distinguished panelists. First, we have Eric Ondik, Senior Director of Market Development at TransUnion since joining TU in 2009. Eric has been at the forefront of sales, managing pivotal relationships across various sectors, including credit unions, fintechs, national card lenders. In his current role, Eric is deeply involved in engaging executives from top card lenders to provide valuable market insights and trends. Welcome, Eric. Happy to have you here today.
Glad to be here.
And alongside Eric, we have Brad Hogan, the U.S. Sales Director here at GDS Link. Brad brings a wealth of experience in augmenting sales and enhancing team productivity. His previous roles include extensive tenures at SAS and Equifax, where he developed key partnerships and expanded the impact of analytics software. Brad's expertise is now a driving force behind GDS Link's growth and commitment to delivering exceptional value to our clients. Welcome, Brad. Excited to hear your perspectives.
Thanks, Matt.
Before we get started, just a bit of housekeeping. If you have questions during the presentation, please type them into the Q&A box on your Zoom control panel. In the interest of being respectful of everyone's time today, we will address any questions towards the end of the presentation. This slide deck will be distributed out to all attendees, and the session is being recorded and will be available for replay at a later date at gdslink.com, transunion.com, and our respective social media channels. Let's go and get started today. First, want to give notice to a recent report that TransUnion recently published, their holiday shopping report, which provided a comprehensive breakdown into consumer behavior and preferences during the holiday season. As most of us who keep tabs on GDP figures have seen, the U.S. economy continues to defy threats of a looming recession, growing by nearly 5% in the third quarter of this year, with strong consumer spending once again growing at an unexpected pace. From the findings in the holiday shopping report, there does not seem to be any signs of this consumer spending slowing down, at least through the end of 2023, with 83% of households planning to spend at least the same amount as they did last holiday season. Eric, while the trend of spreading out expenses is not too much of a surprise, what impact do you see higher borrowing costs and the restart of student loan payments having on consumer spending this November and December?
So I think that consumers will be a little, more conservative in what they're purchasing now, even though their plans to be spending at least the same amount or more next year. They're probably not getting as many goods due to inflation. So they'll probably see less transactions, less purchases, but higher balances. The key thing to understand here is that even with the onset of the student lending repayment, we do see a high percentage of consumers from another survey that we did. So we have more than about 60% of consumers plan to pay the full amount of their student loan. I think it's only 13% don't plan to pay it all, and the rest will make partial payments. So I think consumers will still go out to spend. for Q4. Last year, from Q3 to Q4, we saw about $65 billion in balances added to the outstanding balances for card. Not sure if I'd expect the same, but again, another large increase in Q4. And then when it comes to next year, we generally see that paid down a bit in Q1. So historical trends show that Q1, we get a lot of the balance pay downs. That could be early tax returns coming back to consumers, more balance transfer offers going out to where they're transferring those balances to, a zero rate. So I think that, again, there's, all positive signs right now when it comes to spending between Q4 and Q1. And I'd expect those trends to continue in terms of the balance pay downs and actually the delinquency pay downs as well.
Sorry about that. Another interesting insight in the report was there seemed to be some indications that consumers may start pulling back from digital shopping, reverting back to in-store. Kind of curious if you have any insights there.
Yeah, I have some opinions on that. So what we saw is that around 56% of consumers plan to do only half of their shopping online. Last year, that number was below 50%. So I think that consumers, as they're making these purchases, there's a couple things to consider. One, because they're going to be spending more, they may want to make sure that they're getting the right product that they want. So they want to go in store to see it. Two, when it comes to shipping, right? So consumers, some of us has already started our holiday shopping, some have not, and some will be very late to the party. So there could also be some, shipping issues that they could run into where they wouldn't receive that in time. But I do think it's a positive, especially for card. Generally, when you shop online, that's where you see a lot of the BNPL, at checkout. And I think this will be a good opportunity for lenders to really focus on more of that incentivization of consumers by, offering them coupons, different rates on their purchases. So, with over 56% saying, okay, we're going to spend half of our time in store, I think that's really positive, especially for card usage. So we should see increases there.
Thanks for that, Eric. As we move from the panoramic view provided by our market trends and insights, it's clear that the economic landscape is painting a pretty complex picture for consumers and lenders alike. With outstanding bank card balances seeing a significant year-over-year increase and average balances climbing steadily over the past 18 months, the impact of inflation is palpable. As we anticipate seasonal spending spikes in November, December, these insights are not just figures on a chart, signals that can help shape strategic decision-making for lenders nationwide. Brad, question for you, especially with this chart up kind of showcasing, again, kind of gleaning on the outstanding bank card balances and the increase that we've seen there. With inflation driving consumers to leverage their lines more heavily, what specific strategies would you recommend to lenders aiming to ensure their bank cards are top of wallet this holiday season?
Sure, Matt. I think there's a couple of points to take into account here. One, we do see that increase in total balances, but what we want to take into account is what is the leverage of those balances. So as those balances continue to rise, does that amount of available credit shrink, or is it remaining the same? So when we look at that, is that risk really going up, and is that utilization rising across the board, right? Strategy is to take into account there. We really want to look at that kind of as a major risk indicator to see whether a higher percentage of the population is leveraging more of their available credit, or is that remaining steady across the board as income also rises and credit line increases are continuing available credit growth.
And the trend of bank card average balances rising over the past 18 months, this suggests a sustained reliance on credit. And in this context, how can lenders responsibly execute line increase promotions without exacerbating consumer debt?
So again, good question there. I think really, lenders have a wealth of data at their fingertips. And really what we need to be mindful of is helping these lenders harness that data into insights and being able to show the effects that it's going to have on their portfolio. So again, how often are we able to help our lending partners capture increases in income? So as we see, in September 2023, this balance gone up, and the balance being lower back here towards the beginning of the year in December, in December and January of 23, how often has that individual's income been captured? Has there been a pay increase since then? Is there really more available credit to that individual than that's being reflected on their current lines? And are we using that to score these individuals when we're rescoring them for credit line increase programs?
Thanks for that, Brad. Moving from the broader strategies for Q4, we recognize the importance of customizing our approach in a market where consumer behaviors are as varied as the generations themselves. So as we pivot to this next segment, certainly want to sit down to make sure we understand these differences and how they can inform and shape targeted marketing strategies. Eric, your expertise in market development has given you a front row to the shifting patterns and credit card usage across these different age groups. In this first slide, we see a breakdown of the total volume of bank card originations over the last 18 months, with Gen Z consumers increasing their share of originations year over year, while millennials have declined slightly and baby boomers continue to decline since this time last year. As we take a look at the total volume of bank card originations segmented by generation, Eric, how can lenders tailor their initial outreach to new customers? What offer might resonate most strongly with each generational cohort?
So I think in terms of engaging different generations, especially the younger Gen Z and millennial generations, it really comes down to a strong digital engagement. A lot of these consumers and individuals grew up with the internet, and now with the emergence of different credit monitoring services and lead aggregator sites, which maintain offers for lenders, there's a lot at their fingertips. So they're much more savvy around how things could potentially impact their score. They also want to know, I think, more than anything, what do I qualify for before I make my purchase, right? So I want to make sure that I'm getting the line that I want, the rate that I want, before I move forward and get an inquiry on my file that that will impact my score in the short term. So I think they've become a lot more savvy. What I would say is that the emergence of pre-qualification for card lenders has increased more recently. I think for consumer lending, it's something that's always been kind of a bedrock of how they've done business, right? The check your rate. And now that's starting to make its way over into card. I think they require that. They also, when it comes to, switching between devices, they want to make sure that, everything is saved. So they want that continuity across the various devices that they have. They also want to, things a lot more quickly, right? So I think if you were, a Gen X or baby boomer, you may be willing to take more time in order to fill out the application and things like that. But when it comes to the younger generations, they kind of expect things almost on demand, right? So when they're coming in, they're looking for, boxes already pre-filled with their information, minimal number of clicks to get to the actual application page or to submit that application. So again, I think a lot of what they're looking for and what lenders can do is really look at their engagement process, both on site, but as well as with the aggregators that are out there to make sure that they're engaging these consumers, because that's really where they're at and what they're really focused on in terms of digital experience.
You actually received a comment in the Q&A already that actually is kind of pertains to this next slide here. I guess our audience is kind of curious if we can kind of talk about how the generational trends play a role in consumer spending during this holiday season. Obviously, this chart kind of shows a little bit of a significant balance share increase among Gen Z, millennials, with baby boomers declining. Kind of curious how folks can kind of take advantage of this during the holiday season.
Sure. So I think that now with the emergence of the Prime Day deals and the Walmart Plus type of days that happened long before, the traditional Black Friday deals had started, I think there have been consumers who have started shopping, much earlier. We tend to see that more in, households where there are kids present, right? So families tend to buy, I know we've already started holiday shopping. We have kids, so it's, you get the toys when you can get them. That way you're not in a scramble to get the most coveted toy with only a month to spare. When it comes to the younger Gen Z, right? So I think the oldest Gen Z right now, maybe 28 years old, maybe a little less likely to have already started a family. As you can see just from the balance build here, not only are they taking out the cards, but they're actually utilizing them. They might start shopping a little bit later in time, right? A little more up against the wall, so to speak. So I think, incentivizing them to use, specific products or shop at specific stores, can really help. I think, what they look for is more of that personalization when it comes to the messaging that you want to put out to them. So they want the, show me, you know me. So they want things that are relevant to them, or else they're just going to, swipe right. They're going to get rid of the notification. So I think the key thing is to understand your consumer or your customer, not just from a credit perspective, but also a demographic perspective, to understand what's the most likely type of messaging or advertisement or offer that I can put in front of them that is going to entice them to take it.
Great insights there, Eric. Obviously, tailoring campaigns to general expectations is to make a significant difference. So we've navigated the landscape of generational preferences, how that can steer the direction of credit card usage. Let's dive a little deeper, how we can understand and predict behavior over time through the power of trended data. As we turn to this subject, it's important to recognize that trended data is not just about looking at the past. It's a compass that points to the future. By examining credit card behavior over time, lenders can engage in activities that can really kind of give more insight into how a consumer will begin to act after the offer has been extended. Brad, you've been instrumental in demonstrating how data can be transformed into actionable insights to clients' GDS. Can you briefly outline, maybe to level set, how trended data enhances our understanding of customer credit behavior?
Yeah, absolutely, Matt. I think this is one of the things that really gets me excited when we start talking about this is the use of trended data and being able to see a consumer's behavior both at a macro and a microeconomic level over time, and not just to see how they're behaving at this exact point in time, but how they've behaved over periods of time in the past. And all things being equal, that behavior of time over past will often be able to predict how they're going to behave in the future. Therefore, you can take that predictive data that we have, use that to develop attributes, and really take those attributes and put them into your custom scorecard models, be able to extract that data and better score your customers' behavior over time, come up with more accurate scorecards and better actionable data from those attributes. The thing I love about trended data too is if that behavior has a huge deviation from the mean, usually there's a major life event that you're going to be able to detect there. And you can often proactively act upon that information before that customer goes into, a period of financial strain, or before that card goes past due. You can reach out to that customer. You can offer them really different options to best fit their needs with that change in lifestyle. And that can really lead, from the insight to action, lead to a dynamic credit limit, and be able to really detect where that person's going if there's a major change, acting upon that change and working with that customer to maintain a profitable long-term relationship with them.
And maybe kind of, can you maybe speak a little bit more to how does a dynamic credit limit management kind of benefit from a trended data approach?
Sure. When you're looking at trended data, you can really take a look at that person's credit utilization over time to see, okay, we see, for the past 24 months, in the summertime, there's a rise in credit utilization due to paying for a summer vacation. There's a rise for back to school. There's a rise over the holiday shopping season. And then as they go into the fall and winter, the spending's not as heavy. They get tax refunds, maybe get a bonus from work after the new year. So they use that to pay off that debt that goes down. You can really use that to dynamically lift and dynamically schedule those credit line increases as those events happen across time. And again, when we go back to the life event detection, should there be a major deviation in that behavior and a major change in that utilization, that's a major indicator that something's happened in that individual's life and is a good point to reach out to them.
And I know that you kind of lightly touched on custom scorecard models here. I know that that's something that's a little bit of our bread and butter here at GDS. Could you maybe say how GDS Link Solutions, powered by TransUnion's data, helps enable lenders to implement these strategies effectively?
Absolutely. One of the things that I take a lot of pride in, and what really gets me excited about our solution, is the ability to help lenders implement custom scorecards, implement AI scorecards and models into production, into their decisioning systems. Really what it comes down to is being able to take that trended credit data, take that raw data, and put it into actionable insights via attributes, score those attributes for each individual consumer that comes through, and then be able to spit out that score to determine how you can best move forward with that customer going forward, whether that is, a proactive credit line increase of 25% for the holiday shopping season based upon their utilization percentages in the past, whether that's based upon an expected increase of income when their income resets within the next 6 months, or various other trended attributes that you may be seeing coming down the pipeline.
Eric, any other color or context you want to maybe add to how GDS and TransUnion can help deliver these effective strategies for lenders?
I think just to piggyback off what Brad said, I think that, right now segmentation is key, right? So we know that there's been score inflation. Scores still rank order really well, but going to that next level and looking at these attributes. So I think the balance magnitude example that Brad gave is a perfect one, because as my balances increase, it may weigh a little bit more on my score than before. You may opt to give me a different line because my balances are up. But what you don't see when you're looking at static data is that within 2 months, I'm paying that debt off almost in full, right? So the whole key right now is timing. There's a lot of competition in the market, a lot of saturation. So I think that, you want to make the best decision possible, utilizing trended data to segment different score bands and consumers, I think is, the way to go right now.
All right, thank you for that. As we kind of make our way into the Q&A section, once again, I want to make sure that we can hear any sort of feedback, any questions from our audience, whether you're seeking clarification, further elaboration. Feel free to ask any questions you may have or share your thoughts. Again, you can type them into the Q&A box in your Zoom control panel. We do have a question already loaded in. First question, and I think this is kind of interesting. So obviously we've talked about the value of trended data. We also kind of spoke that against the backdrop of generational variance. How can institutions and bank card issuers take trended data like credit scores, utilization patterns, but really help tailor marketing lending strategies to these different consumer segments? So really kind of taking generational variance, obviously getting a little bit micro with this trended data, but then obviously stacking it up against maybe the risk portfolio. Really just kind of curious as to how you kind of really kind of cross-reference against all three of those dynamics. Brad, if you want to take a first swing at it.
Yeah, I think that's a great question, and it's a really interesting question too. And I think, it does go into taking a lot of the demographic data, demographic spending attributes into account, and kind of cross-referencing that against the trended data, the trended credit scores, and the utilization patterns, and then working with that with your marketing efforts, to tailor your marketing efforts specifically to those individual demographic needs to understand not only how those consumers spend, but then how they pay. So understand how they spend, how they pay, and then also, understanding your response models to what kind of offers they're going to best respond to as well. And I think that's one thing that's key here, is being able to incorporate this data also into your marketing response models and those tailored offers.
All right. Thank you for that. Eric, anything else you want to add?
No, I would just say, risk is obviously a part of, marketing strategy. So anything that you're using in the risk environment, or the risk assessment of a consumer, you'd be using in marketing. Now, I think the spend behavior that you see could, Brad was saying card type. I think, we tend to think seasonally on balance transfer type of offers that go out, right? There's generally in Q1, when we know balances for the most part tend to be higher on consumers. But when it comes to different rewards programs that you're offering, so I think there are different things you can look at in terms of behavior that can give you an idea of what type of offer that consumer is looking for, not just in terms of potential card type, but also in terms of line assignment. So what type of line do you want to pre-screen them or pre-qualify them up to? What's that rate going to look like? I also think that, and just one other thing is that, the beauty of trended data is that you can see where somebody is going and where they're heading, right? So you see that trend over time. You can understand that somebody who was a 580 is now a 660, and they're trending upwards from there. So you might be able to actually get to these customers earlier than some of your competitors by identifying the fact that they do have this upward trend. They are taking care of their finances and paying down their debt. So you might be able to make them an offer by the time they're at 680 instead of a 700, right? When your competitor might, or when you traditionally may have. So it allows you the ability to go a little bit deeper with less of the risk.
All right, thank you. Getting a couple questions here again. If our audience has any sort of questions or insights, Q&A button in your Zoom control panel. So you kind of touched on it, and I think it's actually a little bit of a segue here to our next question. And Eric, I'll toss this one to you. Our question is, how can we capitalize on this holiday season while being aware of the potential payment shock in the future? So I think you kind of touched on it a little bit, but again, as we're kind of looking ahead, how do we make sure that bank card issuers are still setting up their customers for success and being able to pay off and reconcile some of these expenses in the future?
I think it's an interesting time right now in terms of cards. One, because right now the consumer has more cards in wallet on average than they've had before. So there's about 3.9 cards that a consumer would have in wallet. And what we're seeing is that as consumer balance goes up, average account balance for a bank card has actually stayed or similar to where it was in 2019, even though since Q2 of 21, we've added 180 million cards, right? So they're spreading balances across more cards. That could be due, one, just because of the high rate environment that we're in, higher minimum payments that are due. They need to be able to spread those balances to keep the payments lower. But I think that, as you capitalize on the shopping season, you can kind of feel a little bit relieved in the fact that historically for the past, I don't even know how many years, we've seen that pay down come in Q1, right? So consumers are going to pay down that debt. The difference is that they have more products and they have more cards in wallet. They have more payments to be made. I think this is where you take the trended data approach when it comes to account management as well. So you're looking at where the risk and potential liquidity shortages of some of these consumers might lead to. So when we're thinking about things like aggregate excess payment, right, that's a really good indicator of liquidity. When you start to see a change in that over time, say over the course of 3 to 6 months, that's when you may want to be more proactive in reaching out to those consumers to make sure that they're not experiencing anything that's going to not allow them to make payment, or to be able to put them on a payment plan so you can minimize your losses.
And Brad, I might kind of pivot to you. And can you kind of speak to how some GDS solution can really help connect the dots a little bit from customer management to collections?
Yeah, man, absolutely. I think, with our solution, it's going to provide that that unique differentiator is when you're going into decisioning and you really, start to see the need to see somebody going into chronic indebtedness where that utilization rate keeps rising over time. At a certain level, it's going to create, an action for a credit line decrease where you're going to cut that utilization and, really kind of cut off that person's line of credit. At that point, I think, you really want to be able to determine what's the next best action to take for that client. From there, you can run it through a behavioral model through our system to really determine is the next best action to do a customer service call to this person. From there, we're going to look at that over time. How are they reacting to that customer service call? Did they engage in a payment plan? Are they not engaging? Did they miss a payment over time? If they've missed a payment over time and nothing's changed, otherwise, is this something you want to push out to early stage collections? And really, developing that response model to go along into your customer management solution to really determine how quickly we could push somebody to collections and how quickly we can minimize losses there.
All right, thank you for that. And actually, our next question kind of touches on what you were just talking about, Brad. But can you kind of maybe dive in and discuss how Trinidad can help differentiate between these temporary life events and more significant shifts in consumer spending habits? And likewise, how could a lender adjust with that data in mind?
Sure. So I think, when we take into account temporary life events versus a major incident that's going to completely change consumer spending events, we really want to look at thresholds. So take utilization for an example. Say annually, when you look at trended data, you see that somebody's annual utilization threshold rises from 10% to 15-20% during the holidays. What you can really do to determine whether there's been a major life event or it's just a temporary fluctuation with seasonal changes is put a cap on that utilization threshold to really make that an outreach. So if somebody tends to vary between that 10% up to 20%, back down to 10% annually in their revolver on that credit line, if you see them go above 35%, that's a very good indication that something major's happened in their life, whether that's an economic event, whether it's a life event, a personal event of some kind. We know that there's been a change. And at that point, that is a cue to push that onto your customer service department and reach out and touch that customer and determine what's going on, what has changed within their utilization, and do we need to make a risk decision at that point?
All right, thank you for that, Brad. Again, if anyone has any additional questions, Q&A button on your Zoom control panel is where you can submit those. This final question, I will turn to you, Eric, and I think we've touched on this a little bit, but one of our attendees was hoping that we could elaborate again how to capitalize on the surge in holiday season spending, but really just trying to be mindful of the impending resumption of student loan payments. I know that in our discussions previous to today, we've kind of talked about how that's certainly a variable to be aware of, but something that at least we're not going to truly get kind of line of sight on immediately. Maybe can you kind of speak to that dynamic?
Sure. So I think that, again, we conducted a different survey as well. 58% of consumers plan on making the full payment. 13% don't plan on making a payment at all. Now, I don't think that means they can't make a payment. I think, going back to my earlier statement on consumers being smarter and more credit savvy, right? If delinquencies for student loans aren't going to be posted to a file and really impacting a consumer score until, the end of next year, it gives them less incentive to make that payment, right? They could very well be liquidity constrained and not have the ability to make that payment. And I don't think anybody is going to, go broke trying to make their student loan payment. But what I would say is that, it's something to where consumers are mindful of this. I think a lot of them can take on the additional payment. What we saw in a study that we did was on average, the minimum payment or the payment on a student loan that a consumer would have to make is $336, right, per consumer. And that's if I don't have a mortgage. A little bit higher if I do have a mortgage. The $336 for a lot of these consumers, they were making these payments prior to the pandemic. They stopped because they didn't have to make the payment. Or some of them, still continued to make payment because it was just part of their monthly budget and they didn't want to lose that. I think what you're going to see now is a mix of the consumers who aren't paying. They're going to be the ones that are still going to hold out for some sort of relief, and whether that's income-driven relief or some other relief that's going to come potentially or from the government. And then those who really can't make payment. I think that's a smaller percentage, right? I think, again, most consumers will be able to absorb some amount of payment on their student loan. They may need to restructure. But when it comes to capitalizing on this year's holiday spend, I think you be mindful of the different behaviors consumers put out there. But at the same time, if you're doing a line increase program, if you're looking at originations, are you calculating the potential where if that consumer has a payment or a student loan on file, are you calculating some sort of payment into your line assignment strategy, or to whether or not you're going to give them a line increase? I think those are things that you can look at kind of with the absence of some information on student loan to be able to make a better decision and be able to capture more of the spend from those customers and consumers this year.
Awesome. Thank you. Thank you for that, Eric. Appears no more questions from our audience today. As we wrap up today's discussion, I want to extend our gratitude to both Eric and Brad for their time and their insights. And thank you to all of you for joining us and contributing to the conversation. Before we part ways, I'd like to highlight a few resources and special opportunities we have to offer. First, if you have not done so already, we encourage you to listen and subscribe to the Lending Link, GDS Link's very own podcast that delves deep into all things lending. With listeners tuning in from now 63 different countries, our latest episode features our host, Rich Alterman, who is joined by TransUnion's Sean Flint as key trends impacting credit unions and community banks. You can catch this episode and more on all major listening platforms. Next, we want to make sure to highlight GDS Link's open banking attributes, a turnkey solution that unlocks the full power of trended and transactional data through 1,000 standardized policy and model-ready attributes, ready to elevate your credit and fraud risk modeling that enable you to tap into new insights like spending patterns and share of wallet with data that has been carefully aggregated, anonymized, and de-identified. As a special offering for our attendees today, we're providing a 90-day risk-free trial of the open attributes. Visit gdslink.com/open-banking-attributes to learn more and take advantage of this exclusive trial. And lastly, be sure to download TransUnion's 2023 Holiday Shopping Report. Today's discussion just scratched the surface on the insights it yields and is a must-have this holiday season. Find it at transunion.com/report/2023-holiday-shopping-report. We'll make sure all of these links are included in our follow-up email that will include today's slides. Once again, thank you, Eric and Brad, for today's enlightening discussion, and a big thank you to everyone here for your attention and participation. If you have any further questions or if you're seeking additional resources, please don't hesitate to reach out to us directly at insights@gdslink.com. We hope today's session has provided you with actionable insights and strategies that you can apply to your own context. Thank you all again and have a great day.